Infinite banking is a finance strategy that has been practiced by smart, inventive, savvy business people, artists, investors, and regular Joes alike for about 200 years now. Again, infinite banking is a strategy, not a product, but the strategy is dependent upon the one product that provides very high compounding dividend interest and the greatest benefit in the IRS code, namely participating whole life insurance. So it is of value to understand a few things about participating whole life insurance. Now, don't worry, this is not a lecture on what may be the most boring topic in the world. I just want to enlighten about a few things that may be of importance to understand as a practicer of the infinite banking strategy that isn't always gone over when making presentations and stuff. So anyway, I'm Stan Cox. Aloha. I'm principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years now, I've focused on and specialized in the infinite banking concept and developing the tax-free cash growth warehouse finance strategy. Now, if you find this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. Now, why does it have to be whole life? You see, the greatest benefit in the IRS code, that is the tax exemption given to cash value life insurance, covers both whole life and universal life varieties. The problem with universal life, all versions, GUL, VUL, and IUL, none guarantee the cash value growth of the policy. Even worse, universal policies are built around a term insurance, and the fees and cost of insurance continue to rise even after the policy is issued. So, and those costs are passed on to the policy or the client. So very often, the cash value of universal life policies tends to get eaten up by the rising costs. And universal life policies tend to take a number of years just to generate any cash value at all to begin with. And then it gets drained by the costs of the insurance. So we find that whole life, with its guaranteed cash value growth, is the only product that works for infinite banking. And participating whole life is best because participating policies earn dividends on top of the guaranteed interest. So the cash value grows even faster. And then with the design, with the design of the policy, when it's done right, it makes the cash value grow even faster and become available for leveraging for the infinite banking strategy much sooner than a standard whole life. So how soon does the cash value of a policy become available? With the proper design of a participating whole life policy, as soon as the first premium is paid and clears the bank, a percentage of the premium will be in the policy cash value and will be available for leveraging via policy loans. The percentage of the premium that goes into the cash value will vary with the parameters of the policy. Those factors include the age and health rating of the insured and how much of the premium is paid to the cash value building writers, such as paid up additions. Now, how much of the cash value can be leveraged and how often? In most cases, you can leverage up to 95% of the total cash value of the policy. There is no waiting period that you have to deal with other than how long it takes for your premium deposits to clear. And that's usually about 5 days. So as soon as there is cash value in the account, you may leverage it with policy loans. And you can take policy loans as often as you want to, as long as there's available cash value in your account. Now, with the right insurance company, your cash value is all there in your account and earning the dividend interest, no matter how much of it has been leveraged. But if you have $10,000 in cash value and you have a policy loan of 5,000, that means that 5,000 of your cash value is being used as collateral for a loan. And that means that only 5,000 of your cash value remains available for leveraging. So as you make payments on your policy loans, and as you make premium deposits, that money that is going into your cash value then makes more of the money in your cash value account available for leveraging. Let's say 60% of your premium is going into your cash value. And if your premium is $1,000 a month, $600 is going into your cash value each time you pay your premium. So if you have $10,000 in cash value and 5,000 is leveraged with a policy loan, then you make a payment deposit. Within a few days, you will have $5,600 available in your cash value for leveraging. If you make $1,000 payment on the existing policy loan, in addition to the premium deposit, altogether then, you'll have $6,270 available to leverage of your $10,600 at 95%. And it doesn't matter how many loans you take, as long as there's available unleveraged cash value. So if you have $6,600 available and take a loan of $2,000 today, you can take another loan of $4,000 tomorrow if you want to. Are policy loans taxable? Well, the premiums paid into life insurance has to be after tax money. When your money is deposited into a whole life policy, it grows tax-free. And when the death benefit eventually is paid out, that is also tax-free in most cases. I'll get back to that in a minute. Loans in general are not counted as income, and therefore they are not taxed. The same is true of policy loans. They are loans from the insurance company, and as a loan, they're not taxable. Even if your loans actually came from your account's cash value instead of from the insurance company's general account, because of the first in, first out principle of whole life, you would not be taxed on the money taken from the policy until you reach the cost basis of your account. So then, what is cost basis? And what does first in, first out mean? Well, cost basis simply refers to how much you've paid for your policy, cost of the policy to date. Total premium is considered the cost of the policy. Never mind that a well-designed policy will have 50% or more of your premiums going into your cash value right from the get-go. Okay, I'm going to share this here. We go. And now we're back on. So if you've paid $10,000 into your policy as premiums, that's the cost basis. If you've paid $100,000 in premium, that's your cost basis. So now let's say you've paid in $100,000 and your cash value is also $100,000. That's still your cost basis. And you could surrender the policy, take your $100,000 cash value, and not owe any tax on it. You already paid tax on the money before you paid it into premiums. On the other hand, if you have $100,000 in cash value, but your cost basis is only $70,000, You could surrender the policy, take your $100,000 cash, but in this case, the first 70 would be tax-free, but you would owe income tax on the $30,000 that your cash value earned above your cost basis. Another situation might be that you're retired and you really don't need life insurance anymore for whatever reasons. And you want to enjoy the extra cash you've built up in your life insurance. And let's say you've acquired $1 million in cash value. You've paid a total of $300,000 in premiums, so $300,000 is your cost basis. Now, you start taking partial surrenders or withdrawals from your cash value. The first year, you take a partial surrender of $50,000. Is that taxable? No, because you paid in more than that before you earned the massive amount of profit that your policy has grown for you. That's first in. So when you take that first withdrawal, that comes out first, and that'll be first in, first out. And you can keep doing that without being taxed until you have taken all $300,000 of your cost basis out of the policy. Okay, I said I'd get back to the in most cases bit about tax-free death benefit. So when is the death benefit not tax exempt? Well, when a person has an estate with assets in excess of $13,610,000, including the death benefit of their life insurance, then whatever is in excess of that may be taxed between 15% and 40% as inheritance tax. So if you have an estate worth $14 million or more, you might want to have a life insurance policy with a death benefit of at least 40% of the value of your estate that is over 13 million. So your heirs won't have to sell your stuff to pay the inheritance tax. But that means that most of us won't have to worry about being taxed on life insurance death benefits. Okay, that's it for now. I hope that you got some value from this, and now you have the answers to your questions about the miscellaneous factors surrounding infinite banking. If so, please like this video and subscribe to this channel. Also, please post your questions and comments here. You have questions, we have answers. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below this video. The link to buy my books on Amazon.com is also below. If you'd like to book a free phone consultation with me, the link to my Calendly page is right below here. If you'd like to apply to become a client of ours, the link to the application is right below. We're here to help, and we look forward to helping you. For now, aloha and mahalo for watching.